In this video, we're going to talk about the stock market. Let's jump into it. So the stock market. So there are two words here. So let's take a look at stock and then we'll look at market right after. So a stock is just ownership in a company. Well, this is great because let's say there is a stock of a company here that you want to own. See right there, you would pay money to a business and return this business would give you a share of the company. The share of a company is known as the stock. Now that you own the stock, you are a partial owner of this business. So that means you actually have a say in how the business is run. So each share actually gives you voting rights. Let's say, for example, there are 100 shares of XYZ company. Now, for easy numbers, let's say you invest $1 into XYZ. Let's say the current price of each share is also just $1 for simplicity. So this means you own 1% of XYZ, right? You bought one share at $1 and there are only 100 shares outstanding for this company. So now you own 1% of this company. But what happens is, let's say the company is starting to do better, right? So this means more revenue, they have more efficiency, and just overall good positive outlook. Well, other investors will see this and they want to get in on the action. So what would happen? Demand will increase. Now what happens when demand increases? That's right. The price of the stock will go up. Now you may see stock charts, right? It may just go up, down, and based on how the company is performing and expected to perform, usually you do tend to see an uptrend, but based on how the company is, you could also see downtrends. And the reason why the markets are fluctuating like this, right? Going up, down, up, down, up, down, it's because of something known as a market. So what is a market? A market is where there is a buyer and a seller. Okay, you can't have a market unless you have this. So for example, think of the farmer's market, right? A bunch of farmers bring their vegetables and fruits to a certain place, and then you as a buyer go there and you could buy the fruits and vegetables. Now, if you did not go there and it's only sellers, there wouldn't be a market, right? As in they can't sell anything and no market exists. Similarly, if you go to a location and there were no sellers, there would also not be a market. So to have a market, you need to have both a buyer and you need to have a seller. And so these price changes based on supply and demand. As in, higher the demand, the price is going to increase. Lower the demand, the price is going to decrease. And similarly with supply. As in, the higher the supply, price is going to decrease. The lower the supply, price is going to increase. And this is assuming all else equal. Now let's take a look at this scenario right here at the top of this hypothetical stock chart. At this point, what's happening is investors are concerned something bad is about to happen. And so they start selling their stock. So when they sell the stock, what happens? Supply increases, which means the price of the stock is going to go down. And so when the price decreases from here all the way down to here, now investors are like, hey, this is actually a pretty good price for this company. I want to buy. So then what happens? That's right, demand increases. So then the price increases as well. So purely based on human emotions and what's happening, supply and demand is going to continue changing. And that's where the price discrepancies happen. That's why the markets go up and down. Now let's do a quick recap. Buying a stock is ownership in a company. So this is super cool because this means you could just sit back, not do anything, and just have management run their company, find their own clients, find their own suppliers. They will do 100% of the work and you just sit back and enjoy. So at this point, the income that you're generating is no longer tied to your time because remember, you have ownership in a company that's running completely without you. This is incredible. Now with stocks, of course, there is risk. Right? If the stock is not going to do well, if the company is not going to do well, what's going to happen? Supply and demand. Do you remember that? So the demand decreases, which means the price will also go down. This means if you bought a stock for $100, it could be trading at $40, for example. That means you would have lost $60, right? So there is risk with this. So it's very important to invest in companies that you think are going to do well. Great. So the stock market, there is so much to cover, but this is just a very high level overview of what the stock market is and why prices change, right? So stock market, again, it's ownership in a company. This is great. This means you can just sit back, not do anything, and you'll basically make money if you invest in the right companies. The thing about the market is that it's an actual place online where you can go to either buy or sell a stock. And based on supply and demand, the stock's price will either increase or decrease based on what other investors believe is going to happen to the stock. That's all we're going to cover in this video, and I'll see you in the next video.